Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is the 4th of May. It's a Thursday. And I got a guest that's actually down here in Florida with me. Coming on today's show, Brett Eversole. Brett is a colleague of mine. He's our first third-time guest. Always brings some great ideas. We're going to talk about what happened with the Fed yesterday, how the market reacted. Then we're going to talk about three sectors that he likes: gold, Homebuilders, and BioTech. Three completely different sectors, but three sectors that are right now sitting near breakouts, sitting near highs. Find out why he likes them, what he's looking at, and of course, his island investment. Way off the grid. You're never going to guess this one. The investment he wants to own for the next 10 years. So coming up right now on Making Money, Brett Eversole. Most investors never touch this segment of the market, but according to the latest analysis from our team at Stansberry Research, this is the number one most important sector to pay attention to in 2023. And we're urging you to move your money immediately. You can stay one step ahead of the market and potentially unlock extraordinary gains just by understanding why this sector is set to boom. I strongly encourage you to read our analysis totally free today. It's all spelled out in a free report we just put together. Get the facts yourself. Go to hiddensector2023.com to get your free copy of this report. You can learn how to profit from the untapped potential in this hidden sector before it becomes widely known. Again, that's hiddensector2023.com for a free copy of our new report. And here he is, our first third-time guest, Brett Eversole. Brett, thank you so much for coming back on and putting up with me now for the third time. Not many guests want to come back a second time, even though I take it pretty easy on them. But you're willing to come back for a beating for a third time. Thanks for joining us.
Thanks, Matt. You know, this isn't much of a lion's den. I've had a great time the last couple of times, and I appreciate having me back. So thank you. Always fun.
Yeah, our pleasure. Always bring great information. So, you know, we're taping this right now, right after the Fed. Fed came out a little over an hour ago. This will air on Thursday, so we're filming the day before. And you and I just sat here and talked a little bit off air about what the Fed did. And let me just give a quick breakdown of the headlines for everybody out there. I'm sure you know by now. But the Fed did come out and they raised interest rates by 25 basis points. That takes it to a range between 5 and 5.25%. This is the 10th straight meeting that they have raised interest rates. The big kind of news that came out is they omitted some prior language before that indicated that rate hikes were almost certain. They omitted, this is what they omitted. The committee anticipates that some additional policy firming may be appropriate. They replaced that with, in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time. So let's break it down what this means, Brett. It means basically what they've been saying for a while now, but I think it really is what they call data dependent, meaning what the data is going to be like between today and the next meeting, I believe is on June 14th, if I'm not mistaken. And then there's one in July as well. So my guess right now is that there will not be a rate hike. A lot can happen in the next 5 weeks or so. My guess is there will not. I think you're on the same page with me, Brett, where I don't think they should have raised this meeting or the last meeting. So obviously I don't believe they should raise the next meeting. What say you of kind of what's going on with the Fed and where you think they should go from here?
Well, you know, I agree with you entirely. I think that it's kind of ridiculous that they're raising, that they raised today and that they did the last raise. You know, they say data dependent, but they were so late to the party in raising rates last year. They were still buying billions of dollars of mortgage bonds and treasuries in the early part of that year. We didn't get cuts until March, I believe, or the first hike until March or April. And they were easily 4 to 6 months behind the curve then. And I think now they've got themselves in the exact same position where they're data dependent, but they're looking at last year's data. They're looking at old data to make decisions for tomorrow, and they're going to be 4 or 5 months behind the curve as well. I don't think it made any sense to hike when they did earlier this year. It doesn't make any sense today, but there's probably a good chance that they'll do it again in a couple of months. I mean, I think that that's silly. I think it doesn't make any sense. If you look at what is their goal, the Fed's goal is to get inflation down. It's the only reason they started hiking rates. At this point, the Fed funds rate is higher than the year-over-year CPI at 5%, with the Fed funds at 5 to 5.25. But if you take the last 6 months of CPI and you annualize it, that number is 3.6%. So what are they waiting for? Like, I just don't understand. We've already had a banking crisis that seems to be mostly resolved but there's no guarantee that things don't get worse. It just seems they are fixated on breaking something in dramatic fashion in order to end this. And I just don't see why that's possible. If the goal is inflation and getting that down, and that's happening, let it happen.
Yeah.
Why do we need to see an unemployment to 5%? I just don't see it. I don't understand.
I agree with you. Two things I want to bring up there. One, you mentioned the banking system, and this is just laughable. Jerome Powell came out today and said the U.S. banking system is sound and resilient. I'll give it resilient. I wouldn't really call it sound right now, but maybe it is. Maybe I'm just being, negative looking at this. That the fact is, I don't care what anybody says. The government, whether it be the FDIC or the Fed or whoever the hell jumps in, will not let any depositor lose money in a bank failure this year, in my opinion. I don't care how big the bank is. And who wins in this is the biggest banks. I personally own shares of JP Morgan in my own account, so I wanted to put that out there. But JP Morgan basically bought First Republic for nickels on a dollar. I mean, so cheap. And it was ridiculous. Yeah, like I love it as a shareholder. It sucks for a First Republic shareholder as though you had a year to get out because it's been going straight down. But how do you respond to that, Brett? When somebody that we put so much trust into in Powell comes out and says a statement like that?
Well, I think it's just funny where we've come in the last 15 years. Because 15 years ago, when the 2008 crisis was happening, everyone was worried about consolidation in the financial sector and the fact that we kind of walked out of it with 4 or 5 major banks. And now here we are 15 years later, and we have a very different situation happening, but we have the exact same result where we've got hundreds of billions of deposits moving from these smaller regional banks into larger banks. And even for the ones that, Signature and SVB were not bought out by one of the major banks, but where do you think that those 40, 50, 60, 80, $100 billion in deposits fled to that caused those bank runs to begin with? So I don't know when it's going to happen, but we're setting these systemically important, too big to fail banks are only getting bigger, only getting more important. And we all know how that ends up. Like at the end of the day, the taxpayers have not really felt the burden of these bailouts for the most part, not explicitly at least. The FDI insurance is going to cover that, and that's paid through the banks. Of course, as people who bank with those banks, we'll end up paying those fees, but we're not explicitly paying at these bailouts. But as those big banks get bigger, regulation can never see the next thing coming. They always regulate the last thing that happened. So eventually we're going to have a bigger crisis in the banking sector. I don't think it's going to happen sometime soon because I think generally speaking, those big players are in good shape. But eventually they're going to need a legitimate bailout from Main Street. And what's happening now is just exacerbating that problem and probably making it worse when it happens and making it going to show up sooner.
It is going to be worse when it happens because if what's going to happen is you're going to have several large banks that control basically the world almost. I mean, there's deposits from all over the world in these large multinationals. And if something were to happen in 08, 09 situation again, clearly, hopefully we're not going to be as leveraged as we were back then, we being the banks. But yeah, when you have such a small little chasm of companies, if one or two goes out of business or fails, that could cripple an economy for years. And do you want to be negative? But go ahead, Brett.
Yeah, I mean, do you want to be where the Swiss are right now, right? With UBS taking over Credit Suisse, there's not a second player in that system. Like that's a monopoly at this point. Basically, banking in Switzerland is a monopoly. That's not good for anyone. Like there's no way that's good for the system. That's not good for citizens. It's not good for anyone. And we're pretty far from that in the U.S. We have several major banks. But we know how this game's played. As time goes on, consolidation continues to happen. The rich get richer, the big get bigger, and it's only a matter of time until you end up there. And I mean, banking is important to economic growth. It's not something that we can just fully turn into a utility. But we're moving towards that path as the big players get bigger and bigger and bigger. And I think that you don't really see, that's kind of like a slow bleed on economic growth. You don't see it. It doesn't show up in headlines, but it stifles business. It stifles loans like these. The JP Morgan does not want to make the same kind of loans that First Republic made. It does not want to make the same kind of loans that Silicon Valley Bank made, that PNC makes. You need to have these different players for the economy to really thrive over the long term. And so this is a degradation of that key functioning of our system. And I think it's a real problem.
It is a problem. And I don't want to harp on it too much, but it's something that I don't think we're done seeing
Yeah.
all the issues coming out. It's and it could take years, honestly, to see all this stuff come out through the system and what's going on, how these rate hikes really affected the financial system. And we talk about these rate hikes going back to the Fed. The fact that they raised 25 basis points this week is mind blowing to me, because we both wanted to pause, right, Brett? But I don't understand why. And I know Powell said this last year. I mean, he telegraphed this, saying we're going to continue every single meeting. He basically said that we're going to raise it. We're not going to pause, and we're not going to do that. We're going to keep going. So we should know that. That being said, what was the harm in not raising 25 basis points today and just waiting till July, August, and just see how it plays out, see how the banking issue plays out, see how the inflation numbers play out, see how the economy plays out? Why couldn't he do that? To me, that's just pure stubbornness. There's no logic behind that. Or am I missing something?
No, I mean, I think in a lot of ways, like you said, like he's painted himself into a corner, and he doesn't have anything to do other than the thing that he's just done. So he's just kind of stuck there. But it is crazy because these rate hikes take a long time to really work into the system.
Yeah.
And so I don't know if the 25 bips today is really going to be a thing that causes a problem 6 months from now, if it happens. But it just doesn't make any sense to do so much so quickly and not just let it filter in a little bit. Just let it filter in just a little bit. Give it a little time, see what's going on, and then you can always act. And the funny thing about this is, if stuff really goes wrong, we'll just be at 0% rates overnight. They'll just cut it by 250 basis points. So it really doesn't matter. So just chill out, just see what happens. Like, you did all the work. Now wait a minute and see what's going on. And it's just crazy to me that with inflation down so much, that there's no change. There's no real change in posture. Mm-hmm. I don't understand. Data dependent has become kind of a meme. It's just a joke at this point.
Yeah.
Because they want to do what they want to do, and they'll find a justification, whether it's
because the data is showing inflation's dropping like a rock. So if they was really truly data dependent, and the jobs market's still hot, but it's not as hot as it was. So things are moving in the right direction. That's the thing. Powell, being an older gentleman, reminds me of very young millennials or Gen Z, whatever the hell they're called. Lack of patience. They want something right now. They and they're stubborn, and that's how I view Powell and the Fed right now. But all right, we don't want to beat the Fed too much here. So let's move on to the reaction. Again, we're taping this, about 3:20 or so p.m. Eastern time after the Fed came out. The market was up slightly, Brett, before the Fed came out. It went down a little, spiked up as it always does, then just sold off recently. We're down 0.2% or so on a SPY. So we're basically unchanged. Not a lot of reaction going on during the press conference that Powell's putting on right now. What are your view on stocks right now? I mean, looking at the charts, I see the S&P 500 close to a major breakout around the 418 level, and the SPY it's at around 410 now. We had the Qs, the Nasdaq 100 actually break out to a multi-month high intraday late last week. Are you still bullish on stocks here?
Yeah, I mean, I think it's kind of, it's a two-sided of the coin. I personally think if we get a recession, it's going to be a pretty mild recession. And if that's the case, then that October low is almost certainly going to be the low in my view. If you just look objectively at the market, it's hard to come up with a really good reason that stocks are going to break down below that October low with what we know right now. So like you look at Q1 earnings that have come in, they've come in down around 3.5%, I believe, so far versus last year. But that was versus, I believe, the expectations at the start or the end of March were like -7 or -8%.
Yeah. Yep.
So the earnings have come in not great, but better than anyone expected. We're going to get that earnings recession 2 quarters in a row of declining, but everybody knew that. We kind of knew that going in. That was priced in 3 months ago. So you've got earnings holding up pretty darn well, all things considered. I think the likelihood of a major recession pretty unlikely at this point. Stocks aren't cheap, but they're not expensive. They're pretty much in line with the 5-year average on a PE basis and only slightly above the 10-year average on a PE basis. And then what's most interesting to me is positioning right now in the market. So usually you see investors get incredibly bullish at the top and incredibly bearish at the bottom. And then once market's up 15% off the bottom, like it is right now, you would expect that bearishness to dissolve a bit. But that's not what we see right now. If you look at the commitment of traders, which is the futures market for the S&P 500, the mini contracts, that's actually the most negative it's been since 2011 during the debt ceiling U.S. credit downgrade. And we've only seen similar setups 3 times in the last 12 years or so, 12, 13 years. And the market was up 15% a year later on average over those periods. So investors are positioned very, very bearishly, despite the fact that stocks are going up. To me, that's a recipe for stocks to keep going higher. I mean, I know it's very easy to nitpick and say, well, earnings are down and the economy's slowing and this and that and the other, but all that stuff doesn't really matter for the next couple of months. What matters is what do people expect and what are they positioned for? They're positioned for the market to go down. And when everyone's positioned for the market to go down, guess what? The market tends to keep going up, especially when it already has upward momentum. So I think long term, it's hard to be pretty bearish, and intermediate short term, I mean, I think it's I think kind of the bulls are in charge.
Yeah, you make a great point. On Tuesday's show, I went through a bunch of charts. The one that you mentioned, that statistic you just mentioned, I also went through the Bank of America the fund manager survey showing net percentage overweight equities versus bonds. We're obviously more overweight they're more overweight bonds now to the highest level since March of 2009. We know what that was. That was sort of one of the better bull markets in the last several decades. We have money market funds at over $5.2 trillion. That money is going to go somewhere at some point. I mean, we could sit here and go on and on of all the contrarian indicators that make me bullish. The amount of people really throwing their hands up. And you talk about an earnings recession. No kidding. We know that, right? I mean, if you didn't know that was going to happen, where the hell have you been living, under a rock recently? And I think it was Mike Wilson of Morgan Stanley came out recently and said, the S&P is going to fall to 3,000 because of this earnings recession. I'm like, that's priced in. If you didn't price that in yet, again, it's like you're buying or selling based on the future, not on what happens in the past. And I think we need to look at that. And you made a good point that these earnings are priced in. Everybody's already negative already. It's not like suddenly something's going to come out. Maybe something that's happening in the financial world and in the regional banks that we don't know about. But it's interesting. I was with you last week in Annapolis in Maryland with all of our other lead analysts for 2 days, and it's always kind of funny. You and I'm always the bull, so I'm sometimes literally on the side by myself. But you've joined me over the last year or so. But I feel like we did this about 8 months ago, and we were probably one of maybe 2 or 3 bulls in an entire room of 30 people. About 40 people this last week when we had our meetings, Brett. And there's more bulls, but again, I think you and I still are on the far one side, and we have a lot of smart people that you and I respect for many, many years that see a huge pullback in the market, like a big pullback in the market. And I don't know how you feel, but I like that. I don't want to walk into our semi-annual meeting and be like, we're all bullish. That's going to scare the hell out of me.
Yeah, I agree entirely. And I think the thing that you said is important in that we did have that other meeting in the fall and nobody was bullish back then. That was maybe in September. It was pretty close to the bottom. Yep. And you do expect people to get more bullish as prices go up. And we've seen that to a certain extent, but we really haven't. And it's because there's so many things, there's so many whatabouts like in the market right now. Well, what about the Fed? What about interest rates? What about earnings falling? What about this recession that has been looming for 18 months? There's so many concerns. But like you say, everyone's known about all of these things for at least 6, 8, 12 months. These things are all priced in. And so to me, what's priced in can't be the thing that pushes the market down to new lows. And I'll be honest, last month when the banking stuff started coming out, I thought to myself, kind of like, oh crap, this could be like a major shoe to drop. And then it's really kind of resolved itself. And so you never know what black swan could exist. Sure. But if it doesn't show up, then there's not really a good reason to expect the market to go down dramatically. I think one of the biggest quibbles people would have right now is probably with valuation. But I would point you back to 2000. So in 2000, the market was incredibly expensive. By the bottom in 2003, stocks weren't that cheap. I think the PE bottomed like in the 17s. So, I mean, obviously the market went down a lot. It was down 50%. And there's a lot of reasons why, and that was a long and extended thing. And there's a lot of reasons this is not like then in that regard. Mm-hmm. But stocks don't have to get to a PE of 10 before markets bottom. Maybe that was true in the 60s or the 70s or the 50s, like way back in the day, but markets have changed in pretty dramatic fashion. And the quality of companies that are in the index has changed in dramatic fashion. And so I think it's very easy to say, well, valuations are too high. And I know some people who are worried about that. And they say, well, markets just don't bottom with valuations this high. Well, maybe they haven't often. Doesn't mean they can't. I think over the last 3 years, we've lived through, this has never happened. And then it happens over and over and over again in financial markets. So you got to just look at the weight of the evidence. And to me, the weight of the evidence is being bearish might make you feel smart, and it might feel a little better right now because it's hard to be bullish. But if you just look at everything, how could you not be bullish on this market?
Yeah. And be careful with the 70s there. I was born in the 70s, young buck. 50s, 60s, I'm all right. When you get in the 70s, I'm starting to get, we're getting close to a big 5-0 in a few years. So let's dive into the markets here, Brett, and some of the reactions that we've seen and kind of stuff that you're looking at, you and your team are looking at now. One thing I know that you are bullish on, and I think you recommended a stock recently in this sector, is gold. And we have gold trading higher after the Fed came out with the decision, even after the press conference. It's around $2,030 right now, so $2,030. And that's been a bit of a psychological level a lot of people look at, not far from the all-time high. I've had a lot of guests on as of late that are calling for 3,000 gold. They're pretty darn confident in that. As you probably know, I'm not a huge fan of gold, but I have said over the last probably 2 months that I'm okay with a little bit exposure to it. And that's just based off simply, I think the US dollar continues to go lower, and I think it's a nice way to hedge that. I also love copper and some other commodities as well. So what's your view on gold and what makes you bullish right now?
Yeah, I mean, I'll probably, if you've had guests talking about this, I'll probably tell the same story, because I think gold is definitely headed to 3,000, maybe higher. Gold is in a very interesting spot because it's kind of like the stock market is right now. Like we talked, the market's up, but people still hate the idea of owning it. Mm-hmm. And so gold's in the exact same spot, except it's like a couple of percent away from an all-time high, and literally no one owns it. So if you look at that commitment of traders, that futures market, mm-hmm. Futures traders were incredibly bearish when gold bottomed last October, and they've gotten less bearish in the past 6 months, but they're still far from bullish. So the metal is up 30%, something along those lines, almost at new all-time highs, and people really are still positioned pretty bearishly. If you look at ETF shares outstanding, this is the thing we like to look at. So for GLD is the largest gold ETF, and these ETFs can create share counts. They create shares based on investor demand. So if somebody tries to buy $1 billion of GLD, it creates enough shares to fulfill that order. And then it goes out and buys the gold to, backfill what it needs. So if you look at those share counts, you can kind of see in real time whether investor dollars are chasing or not chasing a certain investment idea. So for GLD, it is at like a 3-year low on shares outstanding, despite the fact that gold is at an all-time high. And GLD is very much to me like the retail way to buy gold. So this is what individuals think. So regular mom and pops have no exposure to gold, even though it's hitting new highs. And you tapped into something. So to me, like positioning again is very much for gold to move higher, not lower, which is incredibly surprising given that it's almost at an all-time high. Thinking longer term, you really tapped into it. If you study why gold moves, it is 100% a dollar story. People talk about inflation. Real interest rates are important, but it's really a dollar story. So since 1973, the dollar has been down 21 years. And in 18 of those years, gold was higher. The 3 years it was down, when the dollar was down, it was down like an average of 2%. So basically, if the dollar is falling, gold's going to go up, which makes perfect sense. Gold doesn't have industrial uses. It's not a useful commodity in a way that a lot of commodities are. That might be a reason why you don't like it. That's why Warren Buffett hates gold. Like, it doesn't do anything. He likes productive assets, right? Which I understand. But because of that, gold, it really is kind of like a currency. And so if the dollar is going down, then the denominator for gold is going down, gold's going up. It's really kind of that simple. So the dollar peaked last fall and has been dropping ever since. And we had that massive rally because of the Fed massively hiking interest rates and being ahead of the global curve. They hiked again today, and they might hike again, but they're going to be ahead of the global curve when they get to cutting in the future. And that's going to be a massive tailwind to keep that gold rally going. I think we probably saw a long-term secular peak in the dollar last year. It hit maybe a 22-year high. And I think we could be in for a 3 to 5 year extended decline. That doesn't mean the dollar is going to crash and fall 80% and lose its reserve currency status. But if it loses 4 or 5% a year for the next few years, then that's going to push gold to 3,000, 3,500, maybe 4,000. And we just have a massive long-term tailwind for the metal.
I'll tell you, I hope it goes up for your sake and for people out there who are watching and own it. But holy smokes, the comments are bad enough already. Like they're going to crush me if it goes up that high. I'm going to have to I'd have to go buy one share of GLD just to prove that I might have some skin in the game so I don't get crushed too much. If you're right. I have an interview that's going to air next week with Jim Rickards. Obviously, he's big bull fan or a big gold fan, and he's calling for way up 5,000. I don't think it's going to continue to go up much higher. So there's definitely a lot of people on the same side with you out there, Brett, right now that believe in all that. So talk about gold. Just real quick before we move on. A way to play that for investors at home is it through GLD where you're actually tracking the price of gold, or is it better to buy individual stocks, or maybe like a GDX that's a basket of gold equities? Do you prefer the equities over that, or are you more of I want to have this thing in my safe, this gold bullion in my safe?
No, I'm not the physical gold kind of guy. I know a lot of people are, and they view it as kind of the like safety from the apocalypse. I don't know. I'm an optimist. That's why I'm generally bullish, right? So I'm not really worried about Armageddon type things and having gold coins that I can barter with. So that doesn't really fit my bill. I mean, I think if you think I want to have some gold, if you don't want to be very active, but you want to have some gold in your portfolio, GLD is fine. Coins are fine. Anything like that's fine. If you want to be a little more active, the gold stocks are going to give you kind of a leverage factor to gold. So if gold's up 20 or 30%, GDX might be up 50 or 60 or 70%. Mm-hmm. So it's going to give you kind of that leverage factor. That's more risk. You're taking kind of a more beta on the trade, if you will. So if you want to do that, then that's the way I'm recommending to readers, not GDX, but through a specific gold stock. But it is a riskier, kind of a more active way. So it just depends kind of your own situation.
Yeah, whatever your risk profile is, what it falls into. So let's move on to another sector that's doing well that you like also, and that's biotech. And I've loved biotech for probably my entire career, 20 plus career. There's just something fascinating about the future of medicine and how things can change and the breakthroughs that we've had. This morning, Eli Lilly's up over 6% today because they came out with a drug that said truly stopped the progression of Alzheimer's. I mean, just like one of the greatest things we've heard in a while. And that's such a debilitating disease. My grandmother had it. It's just horrible to watch people go through that. If this is truly the efficacy is as good as they say, and it's approved by the FDA, I mean, there's a lot of game changers. I think, honestly, Brett, in the next 10 years, the biggest change that we will see in our normal everyday life will be healthcare and medicine. With the combination of artificial intelligence, drug discovery, all the data that we have, all the health features we can wear and put on ourselves, preventative medicine. I think, truly it's going to change the world. So obviously we have XBI, we're just looking at that. That's the Spider S&P Biotech ETF, breaking out today to a new about 2-month high. So what is your view on biotech and how are you still bullish on this longer term?
Yeah, I definitely am. I mean, I agree with you basically on everything you said, that if you want to think very long term, then think about the things that are going to change the world. And it does seem like we are at a kind of a precipice with medicine where software type technologies and AI can interweave themselves with biotechnology to really create some incredible breakthroughs. And, at that meeting we were at last week, Dave Lashmet, who's our in-house biotech expert, talked about the Alzheimer's data a little bit. And it really is just absolutely incredible. A thing that many, many experts for many decades basically said is incurable. There's nothing we can do about this. And now there's real success being made. So, I'm not an expert on biotech, but what I am an expert on, or maybe not an expert, but what I know a lot about is how these kind of cyclical sectors tend to trade. And generally a cyclical like biotech, if it was trading down while the market was trading up, you would kind of maybe call shenanigans on the bull market overall. So to see a cyclical like biotech trading very, very well in, we're not in like a ripping bull market. We're up from the low, but it's been kind of sideways, kind of churny. So to see biotech trading well in that environment is, I think, it's positive for the sector, and it's also positive for the overall market.
Yeah, I did a study on this a couple years ago. I think it was 2020. I do like these predictions every year, best sector. And I had BioTech in 2020, and XBI was up about 48.5% that year. So I nailed that one. But I was wrong last year in 2022. I thought, because historically, if you go back and look at the numbers now for XBI, this is just the S&P tracking ETF, that if there's a down year, there was one in 2016, it was down 15.5%. Next year, up 44. It was down 15.5% in 2018. Next year, up 32.5%. So we were down 20% in 2021. I thought, heck, 2022 is going to be great. We're down there 25% in 2022. So I add those together, and I got to tell you right now, there's just too much innovation going on in a sector that it continue to go down 2 years in a row like this. Heck, we're setting up for a big rally in the next 18 months, in my opinion. And it's just one angle of looking at it. But I've been looking at that for over a decade. And to me, sometimes we have so many stuff we look at, Brett, like that we sometimes forget about things. I forgot about BioTech till you mentioned before that we went on air.
Yeah, well, and BioTech's one of those places. We're in the information business, right? So everybody always wants to say how you can make 1,000% here and 1,000% there, and it's really, those kind of things are not that common, right? There are things that go up 1,000%, but they're not that common. BioTech is legitimately one of those sectors, as an entire sector, that can go up 100% in a year, not just in a year like 2021 when everything is absolutely going crazy, because the fundamentals of those businesses can change so dramatically overnight when phase 3 trials come out, and it can completely change. It can turn a $1 billion market cap into a $10 billion market cap, literally overnight, based on a press release. That doesn't really exist in other sectors. And so biotech is one of those places where when you hit the innovation curve and things are coming out, you really can see the entire sector go up 100%, 150% in a single year. And so to me, I don't try to be the expert in phase 3 trial data and then the medicines. I just watch that trend. When that trend is working in your favor, that's something you want to have in your portfolio, because when the trend is working, it tends to keep working. And when it works in biotech, man, it really, really works.
So would your investment of choice then be an ETF to capture the basket and capture the sector versus trying to pick an individual stock?
Yeah, that's definitely how we do it. Again, I'm just not the expert on the individual companies. It really takes a special kind of brain and a special kind of person that really wants to be on top of that stuff to do it. And I'm much more of a generalist. But to me, biotech's something I'm always keeping an eye on, because again, when those trends are working, man, they really, really work.
So another sector that people might really be surprised at that's actually doing extremely well, and that's let's call it the Homebuilders. The iShares Dow Jones U.S. Home Construction Index ETF, which is symbol ITB, today hit the best level since January of 2022. So we're looking at what, a 16-month give or take high in Homebuilders. But Brett, I've been told by everybody that we're in a housing bubble and a crisis right now. What the hell's going on?
Everybody wants to fight the last war, Matt. That's the problem. Yeah. Everybody wants to fight the last war. So the last war in 2008 was an over-leveraged system, and housing took the brunt of it, right? It was really the problem. It was the cause of the big problem and the meltdown, and then housing took the brunt, and you had hot markets fall 40, 50%. Man, that is not where we were 18 months ago. Not even close. So what happened after 2008 is we stopped building houses. At least we stopped building at any kind of a rate that would sustain the amount of homes that we need in the U.S. And sometimes it really just is as simple as supply and demand. We have a lot of people that live in America, especially in the cities where the jobs are that people want to live. Well, we didn't build houses, or didn't build very many houses in those areas for a decade. We have too many people chasing too few homes. That's why the market was so crazy in 2021. And did it cool down when mortgage rates went from 3 to 7? Absolutely. But every tick down we get in mortgage rates, you see a tick up in activity.
Yeah.
The thing is, people anchored to 3% mortgage rates, they're already re-anchoring to 7. And so 6 doesn't look so bad. And at the end of the day, if you need to move and you need to buy a house, it doesn't really matter what the mortgage rate is. Housing is not an option. It's a thing that you have to have. And we've done nothing except exacerbate that long-term supply demand, because in the past 12 months, the builders have started to slow down, or at least for a time, they were starting to slow down housing starts. So to me, in the short term, these are going to be very volatile companies, the home builders generally. But in the long term, this tailwind is so ridiculously massive that I don't know how you could see anything but opportunity in these stocks. And it's crazy because a lot of them are hitting all-time highs. We put NVR in the portfolio last October or last August, maybe. I think it's up 35% since then, pretty darn close to an all-time high. Great company, like probably the best operator in the space. But look at every major builder. All the charts, it's the same chart over and over and over again, because there is demand for houses because people need houses to live in. And these guys can dictate price. Prices are up. They haven't really come down because supply demand, right? It's the same thing. So I think people just have the housing market so wrong. And there's nothing that can fix this problem other than time. We need a decade of overbuilding. And then you could talk to me about maybe a housing crash in 2031. But I don't think it's going to happen, because that's going to pinch margins for the builders along the way. And so I think people just have this story wrong, and they're going to keep having it wrong if they're bearish because of the same reasons they were in 2008.
You know, Brett, I'm looking at the numbers right now from the National Association of Realtors. The U.S. existing home inventory peaked in July of 2007 at 4.04 million. We have been a downtrend for 15 and a half years since then, and we're now sitting at 980,000 from 4.04 million. So we've basically lost 75%. The inventory is 75% lower now than it was 15 and a half years ago.
Yeah.
That doesn't make any sense. And, you know, you can have 1,000 reasons why overbuild and then, but I agree with 100% of everything you just said. And I was reading something this weekend and it was a story about somebody who wanted to sell their house. Because they could still get a lot of money for it, make some money on it. However, they can't sell their house because if they were to move into a comparable home, their 3% mortgage is now closer to 7%, and they can't afford it. So you're having a situation where it's not that the buyers can't afford it potentially, but the sellers can't afford to sell, which means the inventory on the market's lower, which is even better because there's nothing really changing hands, better for the home builders. I mean, is this a weird way that higher rates is actually good for the home builders right now?
Yeah. And so I wrote about this somewhere. I write a lot of places, but I wrote about this idea last week or the week before about how you look at, there's this data called months supply, which is how many months would it take to sell all the inventory at current sales rates. So for existing homes, the month supply is around 3 months, which is very low historically, not at the low, but very low. For new homes, it's at like 7.5 or 8 months. So what that means is builders are building houses, and there's a lot of, in relative scale, there's a lot of inventory, but new homes only make up about 15% of total home sales. So what that means, what I see out of that picture is home buyers, whether they like it or not, are being forced into new homes. If they want to buy, if you want to guarantee that you can get a home in a place because you are moving and you need it in 9 months, people are being forced into new homes. Well, guess what? New homes generally cost about 20% more than existing homes, all else being equal. So to me, this is another floor on pricing. There aren't existing homes to sell. New homes are the only place you can go, and they're by definition more expensive. And so I think this setup, I mean, it's not great for buyers, but it is what it is. And we haven't seen prices come down much because there's no inventory and because you have situations like this playing out. And again, there's no fix. There's nothing we can just do to solve this problem. We need many years of a lot of multifamily and single family homes built. And I don't know if there's will from the companies doing it to actually make that happen. But even if they did, again, talk to me in 2031.
Yeah, exactly. And even if mortgage rates come down, which I think they will, because I think the Fed will probably be forced to lower the Fed funds rate by the end of this year, early 2024, which will naturally bring down mortgage rates. That should just even be a boost. I don't think you're going to see them drop back down to 3 anytime soon, but pulling back down into 5s, maybe 5 handle, that's going to be great for the housing market, in my opinion. I think people are going to realize that the old days of 3% may never come back. Or if it does, it's going to be a long time. And realize that, okay, back in the 80s or so, that you're paying 15% mortgage. I mean, let's be real. 5 is pretty damn good, historically speaking. So before we let you wrap, I always ask you this question every single time. And for the life of me, I can't remember what your answers were the first 2 times. You may not even remember, but it's the old island question. So that one investment, now you got 3 because you already got the first 2. I'm sure Greg, our producer, has them because I haven't kept track of them. because we're going to grade you in a year or two to see how they do in a couple of years. But what is that one investment that you find very attractive right now, Brett, that you're comfortable taking to that island for 10 years with you and your family and just relax and throwing the phone in the water?
Just not thinking about it. Man, I should have been prepared because I'm a third-time guest, but I haven't really thought about it. I didn't mentally prepare ahead of time. I think I've given broad ideas the last few times. I do think it's an easy one because we just had this discussion, but you think about those long-term tailwinds and long-term situation in the housing market. I do think anything that is related to single-family housing or multifamily housing is just a no-brainer long-term bet. We work with a company called CrowdStreet on one of our products that does crowdfunding of real estate deals. In the last, let's say 3 years, I've put a significant amount of my own personal net worth into those deals, almost specifically in multifamily housing in desirable second-tier type markets. And by definition, these are private deals where your money's locked up for generally between 3 and 5 years. So not quite a desert island, but I guess that's what I'm doing with my own money. And I think it fits in with that long-term tailwind. So, betting on the U.S. housing market, I think is a smart bet. And if you can find a way that's unique like CrowdStreet in a good deal to do that, then I think that's kind of a no-brainer. That's what I am doing personally with a long-term holding period.
I think that's great. And, that's an investment opportunity that most investors don't realize is available. And it's not available. I believe you have to be a credit investor, if I'm not mistaken, right? Okay.
That's correct.
It's not available to everybody, but, a lot of our listeners and viewers do fall into that category. And it's just a great way to diversify. I had one of our copy chiefs reach out to me this weekend, and she was looking at a company called Masterworks, which I've been in touch with, and you can invest in art, on a piece of high-end art. And I love this stuff because I think it truly is a great way to diversify. I like investing in high-end alcohol, stuff. I've really gotten into it, but I own collectibles, football cards, baseball cards I've had since I was a kid that are worth money. My grandfather passed down coins to me. I think it's just a great way to honestly diversify your portfolio. It's kind of fun too, saying I own a piece of this commercial real estate over here, this multifamily home. It's just, and I think people feel a bit safer sometimes owning dirt, right? Or owning something versus a stock. I'm not an expert in that, but
yeah, you say that, it's funny. So one of the deals I did, I live near Jacksonville, and it's a multifamily that's being built right next to the airport. Every time I drive to the airport, I drive right past and I point and I say, I own a small piece of that apartment complex to be. And there is, it's a weird feeling, but it feels different than owning a share of Amazon.
Yeah, it really does. Even though you're technically a part owner of Amazon, a very, very small owner of Amazon if you own one share, but you still are. And just for a little education lesson before we wrap up, Brett, I want people when they invest in stocks to think the same way they would if they're buying a piece of dirt or a piece of land, a piece of a property, that you are an owner. And are you okay owning that company and being an owner of that company? Whether it be Amazon, whether it be a home builder, whether it be Netflix, you can make up any company you want. But were you okay being an owner of that company for the next 5 to 10 years? And if you can't say yes, you should not be owning that stock. You should not even consider buying that stock. I think that's something that's a very simple way that you need to look at investing, that you truly are buying a piece of a company. It's not some ticker symbol. It's a piece of a company. It's not gambling. It's a piece of a company.
Yeah.
So just to put that out there, get a little education in there.
Yeah, I think in a post, the stock market kind of turned into a gambler's paradise in 2021. And it's kind of entertaining and fun to watch, but it's really not healthy. And hopefully a lot of people that got into the market for the wrong reasons in that time and maybe got burned, I don't want to be burned for long because it's the greatest wealth creating machine that the world has ever seen. And so, but you got to approach it the right way. You got to think as an investor, not as a gambler. And the point you're making gets at that very much so.
And I use that line all the time. Greatest wealth creation for the average person too. You don't have to be a billionaire to do it, but put 5% of your 401k away, whatever you can afford, try to max it out if you can. You'll be amazed. I used that in my Charles Schwab within 2.5 years of working there. I took that money in my 401k that I never saw go in there and used it to start my first company. And you hear stories like that all the time. So please start now. It's never too late. So get in there now. But Brett, pleasure having you as always. And I'm sure you'll be our first 4-time guest here coming up soon. But again, thanks for taking your time. Thanks for coming on. As always, great ideas. And we'll talk to you soon.
Sounds great. Thanks, Matt.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.